This week has been a roller coaster. We've seen tariff threats, Treasury stress, and then a sudden U-turn. On April 8th, President Trump made headlines by pausing his proposed tariffs, and in response, the markets took off. Stocks surged, Treasury yields eased, and traders felt a wave of relief. Behind the scenes, though, some influential voices are not sharing the optimism, particularly Goldman Sachs. According to Goldman's growth models, this one-day reversal was colossal. It reflected an upgrade equivalent to 95 basis points in one-year forward U.S. GDP expectations. To put it into perspective, this jump is the largest since the COVID crash days back in March 2020. In fact, it erased almost 75% of the market's previous recession pricing from the April 2nd tariff distress. So, does this mean we can relax? Well, not exactly, and here's why. Firstly, tariffs are still on the table. Even with a 90-day pause, the proposed tariffs could still escalate the effective rate by 15 percentage points, especially with over 100% tariffs on Chinese goods. Consider the scenario where this was announced without a pause. The market would have reacted quite differently. Secondly, policy uncertainty remains extremely high. When trade rules are liable to change overnight, businesses shy away from making long-term decisions, and global allocators become wary. Global investors are starting to pull back. U.S. assets once deemed a safe haven no longer hold the same appeal. The risk of synchronized drops in the dollar, stocks, and treasuries poses real threats, especially to unhedged international portfolios. Moreover, treasuries aren't providing the safety net they used to. They wobbled under this week's pressure, a sign of potential trouble. Should bonds lose their flight to safety status, we could witness steeper yield curves and increased market vulnerability. Even the front end of the yield curve is raising alarms. Markets are already pricing in the baseline of 3 Fed cuts this year. However, Goldman suggests that if recession risks increase, we may need cuts amounting to 200 basis points. And we are not there yet. So what's the plan of action? Short to midterm U.S. Treasury yields are starting to appear appealing again, not so much for high returns, but as a strategic form of insurance in case conditions worsen. With short-term volatility subsiding, it might be time to reassess your downside protection strategies. Until we see more substantial tariff reductions, markets may be overly optimistic. Remember, markets have moved swiftly, but the risks haven't vanished. They're just on pause. If the policy pendulum swings back, be prepared.